So I'm just going to go through a full question here for the 2014 higher level interpretation of accounts question. Oopsie, right back here. The part B is to do with a bank manager. There's a loan of 350,000 in which there will be interest of 9% which will be charged. Should be granted to Shannon Plc for future expansion. Two things that have to jump out straight away. The loan is 350,000, interest is 9%. Therefore, we can calculate how much interest we will have to pay per year. 31,500, 350 by 9%. So that 31,500 is interest that they would have to pay on top of getting this loan. Because you can work that information out, you have to include it in the question. It's definitely going to be worth marks. So always make sure you use information that they give you, or make reference to the fact that they aren't giving you information. They haven't given us information here about what the loan is for future expansion. But we don't know if this €350,000 loan will help to turn Shannon PLC into a more profitable company, and then maybe it'll be easier for them to pay back the loan. We've just been told future expansion. I mean, that could mean anything. So that's just something to jump out at you straight away, that you're going to have to make reference to that kind of information in the question. 5 things in part A. Cash sales if the period of credit given to debtors is 2 months. Well, I can't find out my cash sales specifically. There's no real formula for it. I just have my sales here. But I'm told the period of credit, the allowance to debtors, which we know is a formula, debtors over credit sales. I'm going to use 12. Why am I using 12? Because the figure they gave us is 2 months. The period given to creditors, period of credit given to debtors is 2 months. So I'm obviously going to multiply this by 12. 365 would be for days. 43,000 is my debtors. I don't know my, that's it here. I don't know my credit sales. I work it out to be 258,000. If this is my sales and my credit sales is 258,000, how do I get my cash sales? Total sales is cash plus credit. So therefore 950,000 is my total sales. 258,000 is my credit sales. 692,000 is my cash sales. Has to be euros. That's your final answer. Return on capital employed, ROCE. You have to work it out even if they don't ask it for us here. Net profit before interest over capital employed. My net profit here is 47,000. My interest is 18,000. Therefore, my net profit before I took interest into account would have to be higher as I pay interest. So 47,000 plus 18,000 is my net profit before interest. Capital employed is here. It's your bottom. It's your final figures. Your double underlined figures at the bottom of the finance by, and total net assets. 792,000 is that. So this works out here to be 8.21% ROCE. Earnings per share, net profit minus preference dividend divided by number of ordinary shares. We have to work out preference dividend first because we don't have that. Preference dividend is simply going to be my preference shares multiplied by their return. 100,000 multiplied by 5% is 5,000. Now back to my earnings per share formula. We knew our net profit already to be 47,000. That information is given here. Minus the preference dividend of 5,000 divided by total shares, total ordinary shares, which you will find here of 350,000. Your total issued ordinary shares. We're going to ignore any information up here, the fact that there's 500,000 authorized. We're using the 350,000 that's issued. Always issued shares. Works out at 12 cent. Again, use the cent. This was percent. Use the units. There is at least 1 mark going for it. Dividend yield is my 4th one. DPS over share price. We don't have the dividend per share yet. This is how we work it out. Total dividend minus preference dividend. Well, my total dividend is my dividend paid. It's 40,000. My preference dividend we previously worked out to be 5,000 up here. So that's going to be 35,000 on top divided by 350,000 ordinary shares, which I have here. Again, they're my issued ordinary shares. 35,000 over 350,000 is 10%, so they work out in cents. It's 10 cent. My dividend per share. Every share you buy, you get 10-cent return in dividends. Now we have to work out our dividend yield. So it's my DPS, which is 10 divided by my share price, which is in cents, 130 cent. Works out at 7.69%. Round up to 2 decimal places. Always round up to 2 decimal places. So if that was 7.68 4, I would round down to 7.68. If it's 7.685 or above that, 7.69. Last one is the how long will it take one ordinary share to recoup or recover its 2013 market price based on present dividend payout. A lot of information there, but the formula list I've given you, the last one here is my dividend payout rate. My price dividend ratio. It's the recouping the market value. So they can phrase these in a couple of different ways. There are a couple of formulas here that can be phrased differently. The most common one is the gearing one, the debt to capital employed. They could ask you specifically for this, or they could say gearing. You're supposed to be able to recognize that they are the same thing. So same here, my price dividend ratio is my recouping, how long it takes to recoup the market value of one share. Back here, so my price dividend ratio is what I'm going to use to work this out. So my ratio is share price divided by DPS. My share price is 130 cent. Dividend per share we already worked out already above to be 10 cent. Works out at 13 years to recoup the market value of one share. One of the more difficult ones because of the way they ask it. We have to get used to this in terms of recouping the market value of a share is the same thing as the price dividend ratio. They'll always ask you to find it based on dividend payout. That's my part A. I've done this here just as a guide. I don't kind of recommend you spending too long. Obviously the workings are important for part B, but don't get too, this is rough work. Don't get too fancy in how you present it. I wouldn't recommend wasting the time putting together a table. I just did it here just for clarity about what I'm going to go through on it. What I kind of want to highlight is the information from last year. This question was quite easy. So all the information that because I've already done up the part B using the marking scheme and just going through it myself. And I know that this is the 7 formulas that I'm going to need to calculate. I know that I already had this one calculated, I already had this one calculated already. So it's quite simple to work out the other ones there. They're in every single question. These, well, these two anyway, and the bottom two. But in terms of last year, sometimes we actually have to work out the figure for last year as well. I was lucky here in that all of them were given. You'll always get the EPS and dividend per share. You'll always get the gearing, and you'll get the quick ratio. And the last one that you'll always get is going to be the interest cover and return on capital employed. There is one that you generally may not get, and that's the dividend cover, dividend yield. So my dividend per ordinary share that I have here is 12 cent, and my earnings per ordinary share is 15 cent. And I can actually use this to calculate my dividend cover. So if they did not give me dividend cover, which they previously used to not give it, my two formulas for working out dividend cover, I have my net profit minus preference dividend over total dividend minus preference dividend, or quite simply EPS over DPS, earnings per share over dividends per share. So if they do not give you the dividend cover for last year, for basically the easiest way to work out is earnings per share over dividends per share. 15 divided by 12 works out at 1.25. So it's 12 and a third, so or 12 and a quarter. So the dividend cover, which you'll always need for last year, is easily worked out even if they don't give it. You're going to need to always make reference to these 1, 2, 3, 4, 5, 6. Going to always need to make reference to them. The debt to equity ratio you can't work out unless they tell you how much your equity or debt was last year, and it's not necessarily needed. There's some things like that that you don't always need to comment on. You don't need to always comment on the dividend yield last year. You don't need to comment on the real return on shares if you were to include it, or the debt to equity ratio. But for these 6 here, these first 4 and these bottom 2, you must always make reference to them. So the part B here, again I'm looking at my bank loan perspective. So I'm starting profitability. What's their profitability this year? Was 8.21%. What was it last year? 10.1%. Obviously bad, it's gone down. There is the general spiel that we have talking about, okay, what's it this year versus last year? Has it disimproved? And we're comparing it here to the interest. Because look at the bank, we've been given the interest here of 9%. So if you're making 8.21%, the return on capital employed, the company makes 8.21% profit each year, and they pay out 9% interest on this loan. They would be paying out 9% interest on this loan. That doesn't look too appealing. We're only making 8.21% profit, but we're going to have to pay 9% interest on a €350,000 loan, which is quite large. The manager would have to question why the company would borrow at 9% if the ROCE was 8.21%. I mean, if you knew that you were going to make interest off something of 4% and you then had to go off and pay interest elsewhere of 8%, you know you're in a losing position there to start with. The earnings per share is the second thing to comment on here. Was 15 cents last year, 12 cents this year. So again, another negative trend here, and it's a cause for concern. She didn't make a reference to the this is well above the risk, the return from risk-free investment. Of 1 to 2%, not too relevant. It's such a low figure, but it still has to be taken into account. I mean, if you've return on risk-free investment and then you go off and get a loan, you could look at adding these together and say that your ROCE should be a good bit above both 9% and maybe 1.5%, whatever the return would be. So the fact that it's so close to this is straight away is a bad thing, and it's probably going to tell us how the company is doing straight away. My second one here is the quick asset test ratio, 0.45, very bad. It's worsened from 0.9, which is already kind of bad enough to start with. They have a huge liquidity problem. They have only 45 cents available for every €1 that they owe in the short term, and we can see here that their creditors within 1 year is going to be a lot larger than their current assets if we exclude closing stock, because this here is current assets minus closing stock. So they've only 50,000 to play with here in terms of money that will be coming in from debtors and cash and things like that, or investment income due. And the money that they have to pay out is 110 grand. So again, in the short term, they're going to struggle for cash. Company will have difficulty in making interest payments. So if they were to go and get the loan at 350,000 at 9%, this amount that they would owe, the interest due, would rise by 31,500. They'd be even in more trouble. So this again straight away is a cause for concern. Gearing. So their gearing worked out to be 50.5%, which is pretty much neutral gearing at 50%. We would call 50% lowly geared, just because we have that scale of lowly geared versus highly geared. 50.5 is starting to become highly geared. Wouldn't be the most major concerning thing in the world, but what is concerning is this ratio is showing us how much of the company is financed by debt. And if we were to go and get a €350,000 loan, now the company is going to be significantly more financed by debt. So we know about getting the loan, this is going to rise, and it's going to be very highly geared. So the gearing has become less favorable because it's risen from 48%. It wouldn't be a huge cause for concern. Debt to equity ratio is 102%. Ideally, we want that 100% or below. Not too concerning. The gearing will get worse, however, though, if we have a €350,000 loan granted to us. So the gearing would rise to 65.67. This here, extremely important. Ideally, you make reference to the debt to equity ratio as well. But if they tell you that you're getting a loan and you know the gearing is going to go up, this here is going to be worth marks. The gearing will get worse if we get the loan. the gearing with the loan would rise to 65.67%, because we know the gearing are going to be our debt divided by capital employed. So my debt here is 300,000 and 100,000. It's my debentures and preference shares, so it's 400,000. My capital employed here is 792,000. So 400,000 divided by 792 works out at 50.5%, obviously, because that was our answer. But if I add another 350,000 here on a long-term loan, suddenly now I'm up to 650,000 euro for a loan, 750,000 euro for a loan. And my capital employed will rise only by 350,000 we have here to 1,142,000. Gonna compare them now straight away, and we see that there's a huge issue. I mean, out of the 1,100,000, 700 and something thousand is liability, a long-term liability. So that's most of it. Works out at 65.67%. So it's important to be able to work out, if there is a loan, what does that do to gearing. So we don't go into as much detail on gearing if we're dealing with an ordinary shareholder. But when it comes to debenture or bank manager, this straight away becomes extremely important. Debt equity ratio will rise to 191% as well. Ideally, you put that in as well, just give yourself as much chance to get all the marks. The firm would be very dependent on their borrowings, as they would be financed more by debt than their own equity. This, for some reason, was not in the marketing theme for this year, but it absolutely should be. Most years, if you don't include that, you're shooting yourself in the foot. So the fact that they're highly geared, they're very dependent on borrowing. Interest cover has disimproved from 4 times to 3.61 times. Interest cover is going to get even worse if the loan of 350,000 euro is given. Even though we've kind of made reference already about this being concerning, this is another cause for concern. Interest is going to rise by 31,500, 350,000 by 9%. So therefore my interest is going to go up from 18,000 to 49,500, which means the cover is going to automatically come down, because the interest cover is obviously affected by the interest. Security. So fixed assets are valued at 790,000. Include all of them here when you're doing this first statement. You're just showing in terms of tangible, intangible, and investment. After that, then we always just say we'll question about their depreciation policy. And this part here, then we looked at the investments. I'm going to talk about this part first. The tangible fixed assets are 480,000. But already, if we have debentures here of 300,000, this would have only been granted if they would have had security on the loan. So to get security, they would have taken 480,000 euro tangible assets, and they would have used 300,000 as a security, basically a form of a contract. If you don't pay back this loan in full, we're going to take 300,000. That's our security. We're going to take 300,000 of your fixed assets. So that 300,000 is already committed to a separate loan. We can't doubly commit those same assets. So out of our tangible assets, there's only 180,000 which would be available for security after the debenture is taken into account. This is very concerning. Yes, we also have a bit more money in investments, but it's generally more difficult to get that across. We'd be looking at the tangible assets straight away. The investments, we're kind of more interested in just looking at how they're doing. The investments that originally cost 210,000, now they're worth 200,000, so they're decreasing. So again, that's not ideal. But for the security, we're kind of stating about how much the assets are and things like that. But the most important part is to be able to distinguish that tangible assets were worth 480,000. 300,000 of that is already committed to separate security, because if I was to get a previous loan, this has to be secured against something. So they would have used 300,000 of this. So that only leaves 180,000 euro that would be free to act as security for the new bank loan, and that's 170,000 euro short. So again, concerning, they wouldn't have enough security for the loan, which would actually be a huge problem. Dividend cover. Because we're not talking about a shareholder here, we'll only talk about dividend cover, so our policy won't really need to include dividend per share, or won't need to include the dividend yield. Dividend cover is 1.2 times. It's gone down from 1.25. If anything, it should be above 2. A bank manager, we want it as high as possible, so 1.2 times is pretty bad. It's low and it's going to get worse. Not enough of the company's earnings are being retained. This would jeopardize repayment of the loan and would be cause for concern for the bank manager. So the fact that their profits are decreasing already, which is cause for concern. Our dividend cover is basically, we're only able to pay it 1.2 times over with our profit amount. With our profits of 47,000 and our dividends of 40,000. So it's kind of a concern, the fact that most of our profits are actually being paid out in dividend. We're not actually keeping enough profits, which is going to be very concerning because they're going to take on a new loan with interest. And just depending on the question, this is a company involved in the construction industry. I'd have your 2 points to make on why it's struggling, and obviously knowing how they're doing in the short term and knowing how they're doing in the long term. So just try to, I suppose, in your own words, and it probably will kind of, I suppose, make more sense for you. Write down all the industries and say, okay, this industry is doing well, this industry is struggling, and then having 2 points and saying they're doing bad in the short term, they're doing good in the long term because of the exchange rate and because of the coronavirus. So having a general table prepared, and it might be about a page long, you can get very familiar with 6, 7, 8 different types of sectors, and then you'd be very prepared in the exam just to write out your 4 or 5 lines. There's generally not too much information needed. They give out the marks generously enough in that part. Purpose of the loan is required for future expansion. That's all they told us. So we're going to have to question the fact that we don't know whether this will give us extra income. Final point, please do not forget it, because literally just by stating the loan should not be granted because of the above will get you your 2 marks. So the reason they've given information here about why it won't be granted: they have a falling profit, serious liquidity problem with 0.45 was their asset quick test ratio. They're very highly geared if they take on the loan. At the moment they're just highly geared. They're too generous with dividends. They pay way too much. Their dividend cover is too low, and not enough profits are being retained in the business. So all of these are extremely concerning, for they won't have enough interest. They'll have be financed too much by a loan. They may struggle to pay off because they have low amount of cash, and they're actually struggling to make profits anyway. So that's your reasoning behind not granting the loan.